Hello, and welcome to Financial Accounting. Today, we're going to look at 8 accounting concepts. Financial statements are prepared using accounting rules called Generally Accepted Accounting Principles. These rules are necessary in order for stakeholders to be able to compare among companies and across time. Within the United States, the Financial Accounting Standards Board, or FASB, has the primary responsibility for developing accounting principles. The FASB publishes statements of financial accounting standards, as well as interpretations of these standards. Number 1, business entity concept. The business entity concept limits the economic data recorded in an accounting system to data related to the activities of a company. A company is viewed as an entity separate from its owners, managers, and other creditors. For example, a corporation owned by one individual records transactions only of this corporation, but not the person who owns the company. Number 2, cost concept. The cost concept only considers the amount initially entered into the accounting records. It is usually assets cost or purchase price. Property value assessed for taxes, market values, or other appraised values are not used for recording assets. For example, land purchased for $100,000 10 years ago would still be shown on the balance sheet at $100,000 today, even if its value goes up 10 times. Increasing the value of land on the books would in fact be recording an unrealized gain. The gain cannot be recorded until realized. Thus, only when the land is sold for $1 million, the $900,000 gain will be recorded. The new owner will record $1 million as its cost of the land. Number 3, going concern. The going concern concept assumes that a company will continue in business indefinitely. This assumption is made because the amount of time that a company will continue in business is not known. This concept justifies the use of the cost concept for recording purchases like land. If there is a strong evidence that a company is planning on discontinuing its operations, or it is evident that it is going out of business, then the accounting records are revised. For example, the assets and liabilities of business in bankruptcy are valued from a quitting concern or liquidation point of view, rather than from the going concern point of view. Number 4, matching concept. The matching concept requires companies to recognize the expenses used to generate revenue in the same accounting period in which the revenues are recognized. Revenue recognition relates to when revenue would be recorded. Revenues are normally recorded at the time a product is sold or service is rendered. At the point of sale, the sales price has been agreed on, the buyer acquires ownership, and the seller has a legal claim against the buyer for payment. Number 5, objectivity concept. The objectivity concept requires that entries in the accounting records and data reported on financial statements be based on verifiable and objective evidence, for example, sales receipts or invoices. In some cases, estimates and judgment factors would have to be utilized, but the most objective evidence available should be used. For example, a company will need to estimate a useful life of equipment and its residual value in order to record depreciation. Number 6, unit of measure concept. In the United States, since the dollar is our national currency, all economic data must be recorded in dollars. Other relevant non-financial data, such as terms of contracts, may also be recorded. In financial statements, transactions and activities of a business are measured, summarized, reported, and compared using dollars. Number 7, adequate disclosure concept. Financial statements are required to include any necessary footnotes or other disclosures that will contain all the necessary and relevant data that a stakeholder would need to understand the financial condition and performance of the company. For example, financial analysts who read financial statements need to know what inventory valuation method was used, if there were any significant write-offs, and how depreciation was calculated. Number 8, accounting period concept. The accounting period concept requires that accounting data be recorded and summarized in financial statements for periods of time. For example, transactions are recorded for a period of time, such as a month or a year. The accounting records are then summarized and updated before preparing the financial statements. The financial history of a company can be traced through a series of the balance sheets and income statements over a period of time. Thanks for watching this video. Don't forget to like and subscribe. More videos are coming soon.